some discussion on TNA and TZA trading strategies. First question that came in was from Kenneth, and this was during the weekend. And Kenneth said, something interesting just occurred to me. What do you think of the idea of selling weekly at the money cash secured puts on TNA and TZA simultaneously? The ATM premium on both is greater than 4%. Well, it varies with volatility, Kenneth, but we'll see that in a little bit. Since they are mirror images of each other, you could only be assigned one. You could then write covered calls on the one you were assigned and continue to do the naked puts on the other. Maybe Kenneth is using some kind of, looking at some kind of the wheel strategy there, or wheel approach, but doing it on two mirror image ETFs. What are TNA and TZA? They are the 3 times leveraged bull and bear small cap ETFs. TNA is the small cap bull 3 times ETF. As you can see, it was up about 2.7% today with the market movement upwards. Meanwhile, and that's the profit and loss chart on the left, so you can see in the last 3 days there, it's moved up from about 70-ish to just above 80, 82.11, close to the close today. TZA is the small cap bear 3 times ETF. It's going to go counter market. So today it dropped 2.8% with the market moving up. And you can see the last 3 days, it's moved from around 33 at the peak here down to about 28, 27.94, just below 28, close to the close today. So percentage wise, they're mirror images. But of course, you're going to see higher premiums most likely on TNA as it's the higher price. But to do a proper test, that's going to be irrelevant because you're going to be putting the same money into each position. Now to Kenneth's question, selling weekly at the money, cash secured puts on TNA and TZA. They're mirror images of each other. One would be assigned, one would be successful, and you could continue it. You don't consider it a loss. It has a problem though, in large market movements, up or down, even though the same percentage gains up or down. One will have a capped gain. I sell a cash secured naked put. Let's say I did one today with TNA at around 82 or so. Let's say I sold the 82 put. Well, if it goes up to 107, all I'm making is that 3 or 4%. I know that would be a 20% increase or so. I understand a 28% increase, okay, on a weekly time frame. Don't really expect that, but let's say that it did. On the other side, I dropped 28%. And that low range exposure that we have to the bottom there, in that case, is going to be realized much lower. Even if I take assignment here and make that 3 or 4% yield and write a covered call down here for 3 or 4%, I'm still down 15 or 20% while I'm making 4% over here. That's kind of tough to balance out. And that could be the problem. But we're going to take a look at it. But that was my initial thought. And in that regard, my initial reply was, one of us here in the office, I can't remember who. I can't remember if it was the gentleman, Mike Phillips, who co-wrote the Iron Condor book with Ernie, or if it was Greg. And they tested the 2X SPY and the 3X SPY, I think. I think it was the 2X, the Ultra SPY is a better term for it. Ultra Bull and Ultra Bear SPY, using covered calls, figuring the same thing. Also trying it with married puts. And it didn't work out too well long term due to the shifting nature of the securities. With the covered calls, the exact thing that we saw that I just mentioned came into play. When you had those large moves on a leveraged ETF, you capped your gains, even though the premium's good at 3 or 4%. But when a large run, I'm still maybe taking a 15 to 16% loss on one side and only making 3% on the other. And yes, I'm trying to do that and continue to make 2, 3, 4% each time. But if it keeps going the wrong direction, I'm capped one way. An extended bull run, for example, we've seen a few of those in the last couple of years, lasting a month, month and a half. Or an extended bear run. We've seen 2 Septembers where we've been down about 10% and down around 6% over 2.5 to 3 week period. And that's, take September. TNA had a large move down. That's our 3 times bull. And TZA moved up. So the market fell about 6.5% or so. You'd be getting assigned and losing on the covered call portion on TNA and only making the 3 or 4% on TZA. The gains are capped on the winners, and the losers can run against you. It doesn't balance out the downside in significant movements or extended bull movements or extended bear movements as well. But that's all speculation, so I was going to do the back test when I got a chance. Now, what our strategy testing service does not cover, it doesn't convert from naked put to covered call on its own. I'd have to do that manually. But the gains or the losses and the returns of just buying to close the in-the-money put at expiration for intrinsic value or near intrinsic value and selling the new at-the-money put with that lower price the following Monday is going to be almost the same as taking assignment at the higher strike and selling the at-the-money covered call at the lower strike on Monday. Assuming, of course, there wasn't a bigger move between Friday and Monday. Okay, because you couldn't sell the covered call right away on that Friday, remember, Kenneth. You have to wait to be assigned and for the shares to clear. Depending on your broker, you might not be able to do that covered call until Tuesday. Not many are like that anymore, but in the old days, there were some that wouldn't let you do that until the shares, quote unquote, cleared, and you'd have to wait an extra day or so to sell that next weekly call against it. But monetarily, the loss that you would take on buying to close the put that's in the money for the intrinsic value is going to be the same unrealized loss of getting assigned at that same price instead of buying it back intrinsically and then selling a call which risks you getting assigned at the lower value or just selling the same at the money put. So monetarily, this is going to be the same. What's our process? Well, we created a search in the naked put screen. We created a list for just TNA and TZA. We looked for weekly options, only 2 to 9 days out, and limited it to just the at-the-money strike on either security. We closed the position at the end of that week if the put was in the money, just bought it back for near intrinsic value rather than convert it to a covered call. We set up a $50,000 account and told the system to allocate 50% into each new trade. So $25,000 into the TNA at the money puts, $25,000 into the TZA naked puts. I ran the search for 4 months from August 1st to December 17th. Why did I choose August 1st? Well, I wanted to build up the account a little bit, hopefully, before September hit, because I would assume that would be the worst time. And it actually wasn't, which was kind of interesting. But anyway, here's the results. Over roughly 4.5 months, from August 1st to December 17th, the ending cash on hand was $53,454. So it was a return of 6.9%. There were 25 wins and 15 losses over a total of 40 trades. A 63% win ratio. And here we see the average return on the winners was 2.7%. And the average return for the losers was 3.5%. Why wasn't it a 50-50 win-loss ratio? Because in some cases, when you had a gradual bull or bear market, either way, you essentially almost took the full profit on the one position, and you only took a very small loss or almost break even on the other. On September 3rd, on August 30th, Monday, August 30th, TNA was trading right around 90.50. So we would have sold the September 3rd 90.50 put. We took in a premium, I believe, it was a 2.4%. I forgot to jot the premium down. I apologize. And we did 2 contracts for the $25,000 allocation that could match. TZA was trading right around $29, it was $28.80, I believe, on August 30th. And it closed September 3rd at $27.97. We had the $28.50 put. So we only took a 0.1% loss. We kept most of the premium on that position. And again, a little bit move up, a little bit move down, but TNA only went from about 91.20 to about 93.79. It was a very steady market in that case. When we take a look a little bit later, there were actually 2 or 3 times where both were winners. So this one, though it was a win and a loss over the same time period, the biggest difference is August 23rd to August 27th. I figured it would have been in September for one of these, but we see the large run here on TNA, And now this is August 20th, Friday, August 20th over here on the left when it was around 78 or so, went from 74 to 78. And then we had a good run. August 23rd, went from about 82, just about 82 to just about 84, then up to 86, hesitates a little to 87, comes back to 85, and then ramped up on the 27th to 92, right? So again, we would have opened it here on August 23rd, the second block in that case, right when the stock was right around, 82. That's a great color to use, isn't it? Hold on, folks. All right, there we go. So right around here, that's when we would have opened it. Stock opened at around 82, closed at around 83. So we would have had about the 84 strike put, and that was a 2.7% return. But this large movement on the last day caused the TZA bear to take a 7% loss. So you still kept the premium, might have been down about 11%, 10%, but that 3% premium helped hedge it in that case with the TZA ending at 28.55. We had sold the 31.50 put. And most of that would have happened first day and a half and the very last day as well. And again, getting assigned at 31.50 and selling the at the money covered call the next Monday at say 29 or 28 is pretty much the same gain or loss as buying to close this for the intrinsic value of about $3 and then selling to open the 28.50 or 29 put the following Monday rather than converting it to a covered call position. The returns are about the same. The yields are about the same. Okay. The biggest difference though was on Thanksgiving. It was on 11/26. TZA here made a profit of 2.8%, sold the 25 put, and TZA was at 28.10. Big decline. We would have sold the 97 put the beginning of that week, as the stock, of course, was trading right around 96.50, 97.10, somewhere in that range, but it fell to 86.43. So we'd have to buy to close this for almost a little bit over 10 points, and that was a minus 8.5% loss, with making only 2.8% against the position. So you see, if this one was successful and expired worthless, our 25 strike, why was it only 2.8%? During these 4 months, there was larger volatility in certain months than others. So when you have the average volatility, 15, 16, or 17 in some of those months, especially around that week of September 2nd, 3rd, and 4th, August 30th to September 3rd, the premiums were only around 2.5%, 2.6%, 2.8%. Later on, you see them at 3 or 4% when the premiums inflated, but it all depends on what movement had just happened and what occurred in those situations to inflate it. Not every time, every week, Kenneth, are you going to see 4% yields. Some of them we did. But here was the interesting one. There were a few double wins. On September 17th, TNA had a small loss. We would have sold the 87 put, and the stock closed at 86.76. We had to buy it back for 25 cents, 30 cents or so to avoid assignment. Or if you allowed it to be assigned at 87, you'd have an unrealized loss of 24 or 25 cents. Almost the exact same monetary difference come the following Monday when you're looking to do the at the money covered call versus the at the money naked put position. And our TZA expired worthless. We had the 29.50 put, and TZA closed at 30.03. Both of them had a same positive return of 2.8%. A similar issue happened on October 8th. We had the 84 put on the bold TNA. It ended at 85.93, so it expired worthless. For that expiration on October 8th, we would have had the 30 put, for October 8th expiration, and TZA ended at 29.51, so we would have had to pay about 50 cents or so to buy to close the put. But naturally, if we took in $2, we're still making a $1.50 premium. It wasn't even that high, obviously 1.7%. We still took in a positive premium. So that's why it wasn't 50-50 in this case, because sometimes there were two winners. But again, this comes down to the question, is it successful? Well, it was successful over that 4-month period, wasn't it? Over 4.5 months, trading 2 options every week, it ended up with about a 7% return. Okay? Is that matching your trading goals? What are your trading goals with these positions? Yes, we don't want to take losses. Yes, you're trying to look for an extra hedge. Yes, this did balance out in this case with some significant losers. Not big, not as major as I thought we would have seen in September week by week. If I had done a September monthly, said opened a monthly September expiration on TNA, the bull one, on September 2nd, I probably would have been looking at a strong loss on September 17th, standard expiration. Okay, but that's week by week. It was down 6.5% or so, but it was a gradual 6.5%. It wasn't a couple sudden movements, which really hurts on one leg or the other, especially now. And if the discussion comes, if you're using a stop order on one of those puts to close me out if X happens, well, it might breach through that stop and you might get filled at a worse price. But this example showed that even if you did take the worst scenarios and just held it, okay, so you make 7% return over 4.5 months. So yeah, you're looking about, was that 1.3, I think? 1.3% return, somewhere along those lines. Per month, not even that much, I'm sorry, yeah, but around 1.3, 6.9 and 4.5 there. And so I'm just asking, does that meet your trading goals? 1.5, I'm sorry, 1.53. Is that matching your trading goals, is the question. And that's up to you. That's not a question I can answer in that case. All right, and Larry comes in and says, why not day trade TZA and TNA? Well, I don't know. I personally don't day trade options, and I personally don't day trade individual securities. I've never done that, so I couldn't tell you where to even begin with trying to set what kind of stop you want, what kind of gains you want. I can imagine what type of trends you're trying to follow to buy a call here, buy a put there, or just even day trade the stock itself and look for the movements to try to catch the right prices to make 2 or 3% here, 1% there. I'm going to be honest with you, Larry, that's not my game. And that's not what I want to do. I don't know if that's what Kenneth wants to do, if that's how he wants to spend his time during the day, focused on the screen for most of the day, moving up and down. 2 times, 3 times ETFs, Larry, I'll have to give that to you and have to agree with you. Those are probably the better securities to potentially trade daily basis. Even if you're just trading the shares of stock with some of those bigger movements that we saw, this would have been a good time to potentially day trade them as well, maybe even day trade the options. But that's not my game. That's not my experience level. So I'm not even going to comment on that. Other than that sort of the answer to your question, the why not do that. That's why I don't do that. Kenneth will have to decide if he wants to look into day trading the options perhaps on TNA or TZA, or the individual shares themselves in that case, depending on what he expects the movements are going forward. All right. Now, Robert's question, I need to do a little bit more work on. I did do some of the work on it, and I did do some analysis on it, and I was kind of shocked in this case. Robert wanted to ask my thoughts on whether the structure would work for a cost-efficient hedge. He wants to use a married put structure on the leverage bear ETF, TZA. So what he's going to do is buy the stock, buy a put on TZA, and if the market goes down, the married put would increase in price, but if the market's going up, he's hedged a loss on the position. And then he says, I would look to sell calls or any other income strategies to possibly get a bulletproof hedge. And he added, I know that holding these leverage ETFs long-term is usually not advised as the asset loss in value over time. Would the married put offset this? And I came across some surprising things when I started to look at this for Robert. And what I found is that timing was essential. I used almost the same time frame, August 1st through December 17th, looking at it, March puts and January 2022 puts for a married put on TZA that I would structure based on the radioactive trading techniques. At the bottom of the market, around September 20th or so, I believe it was, on that little 6% decline we were talking about, TZA was down in price. Of course, let's just take a look here. Okay, am I back to September far enough? No. Okay, so let's just look in September. So I'm going to reset my chart here for 3 months. Excuse me. I'm going to do a custom. And we're going to do that roughly. Let's just do 8:15 and go to what was interesting is that if I had opened a married put in August, the same time frame we used for Kenneth's discussion on August 1st, it had a risk of about 14%, the structure I would use because of higher implied volatility on a 3 times leveraged ETF. On the very lowest point, okay, I'm sorry, this would have been, I'm sorry, I'm thinking backwards. My apologies. I think someone caught that, but I didn't see that remark there. The low was on the 20th. I was right, September 20th. That's why TZA was at its highest. This is the inverse. This is the bear. Okay. This was the new higher points as it started to come off that bottom. Then TZA started to drop. This was the low point on September 20th. Now, had I opened the married put using a January put option, January 2022, not 2023, had I opened it at 8.1 and went through the August here, coming at the September, and then into the lulls as September went on, and then here's the low point of September. This married put was actually at a loss of 1.5% when SPY was down 6.5, 6.6%. Now, what I also needed to compare that with is what were the small cap prices at that time. What do I mean by that? It's not just about track. These are the small cap ETF leverage. So I need to track this against what was the gain or loss on small cap, not really SPY. That's something I need to look at further for Robert's question. Now, had I opened the married put on TZA using the same or similar January put option, the put option I would have selected, but instead opened it on September 2nd, in that case, rather than October 1st. So right around here on September 2nd, when the market was up at the high right before everything started to decline, had I opened the same married put here, at this point, the married put was at a 2.4% gain. It was showing a profit. But again, having bought it on August 1st or even August 10th, the married put over the same time frame was at a loss of 1.5% on the 20th, or I think it was 1.3%. It wasn't an effective hedge in that case based on the changing prices, changing volatility, and other factors. So I'm going to look at that a little bit more deeply for Robert because I'm concerned about that type of hedge against a portfolio. And what I also need to compare it was, as Larry mentioned, maybe in the case of the market falling down, I would have been better off just buying shares or just buying a call on the leverage ETF as opposed to doing the married put position and putting the capital into it. A lot of these cases, sometimes you see it's things like UVXY, for example, volatility ETFs to use as a hedge. It's actually better to buy shares of the ETF, VXX, what was VXN, and UVXY, as opposed to buying the options so that when there's a large spike, you didn't have to worry about time decay. You didn't have to worry about any of that. You're just owning the volatility shares as the outright hedge, as opposed to playing around with the options looking for a cheaper price. And you could get almost the same price just buying 5 or 6 shares as opposed to buying 10 or 12 contracts to hedge a portfolio. Almost be the same monetary allotment in that case. So Robert, I will get to that a little bit more fully after I do a little bit more research. But in my additional first pass, second pass, third pass, it did not look like it was going to be overly viable as a market hedge using a married put on TZA, or it has to be done with the exact specific timing. Otherwise, it wouldn't work.